If you look at the surface level data on your brokerage app, the silver market looks like any other asset class. You see a spot price, you see high trading volumes, and you see some spikes. But if you look at the actual inventory reports coming out of New York and London, a much more serious story is emerging. Financial analysts across the globe are sounding the alarm on a growing physical supply gap. We're not looking at a glitch in the system, we're looking at a fundamental mathematical deficit that the paper market is struggling to price in. We are currently witnessing the most significant structural divergence in the history of precious metals. And on one side, you have the paper price, a digital number generated by high-frequency algorithms. And then on the other side, you have the physical reality, a world where industrial giants are quietly raiding the vaults because they know the maths no longer adds up. And today, we are not talking about buying dips or moon missions. We are performing an autopsy on the COMEX. They are the ones who are the world's leading derivatives exchange for trading metals, futures, and options, including gold, silver, copper, and aluminium. We are going to look at the registered versus the eligible scam, the 8% lease rate that the banks are desperately trying to hide, and the delivery trigger date that could officially break the price setting mechanism of the Western world. So if you think your silver ETF is the same as silver, you're about to receive a very expensive educational lesson. Strap in, because this is a bumpy one.
Well, big news with precious metal prices dropping at rates not seen in decades.
Starting with a big sell-off in precious metals after a record rally in recent months.
Silver has got completely unhinged from any measure of reality.
Let's start with the big lie, the 400 million ounce inventory headline. In the forensic world, we don't look at total inventory, we look at registered inventory. This is the only metal that is legally warranted, meaning it's actually available for a buyer to take home. As of February 2026, that number was sitting at very precarious 103 million ounces. Now, why is that a problem? Well, that's because as well as the registered silver, you also have the eligible silver. That is the other 300 million ounces, which is essentially someone else's property. So it's a bit like standing in a public parking lot and claiming you own all 400 cars, when in reality, you only own 100 of the cars in the fleet. The rest belong to other people who are not interested in selling. Now, as of the posting of this video, there has been an average of 1.8 million ounces of silver shipped out each day in 2026. In 2020, the average daily shipping was only 420,000 ounces. It's a huge difference. At this velocity, the vault will hit terminal zero within months. But the paper market is still pricing silver like it was falling out of the sky. This is a liquidity gap, and historically, these gaps only close through very violent vertical price adjustments. Now, when the market becomes this tight, the house, the big bullion banks, and the exchange operators, they don't look for more silver. They look for ways to kill the demand. They use three specific mechanical weapons to do this. First, you have the margin spike. This is the most effective tool in their shed. So when silver began its parabolic run from $29 towards $120, the CME group raised the margin requirements multiple times in a single week. And we've seen this done before. Second, you then have the lease rate spike. Currently, it costs around 8% to borrow a physical piece of silver. Now, for context, the last decade, that rate was more like 0.5%. When lease rates spike, it means the big banks are renting silver from each other just to satisfy delivery requirements. It's the financial equivalent of a check engine like flashing that the global economy is breaking. Thirdly, you have the cash settlement clause. Tucked away in the exchange rules is a force trigger. So if the COMEX literally runs out of bars, they don't have to give you silver. They can hand you a stack of depreciating US dollars based on a fair market price that they determine. Now, while the COMEX paper price was recently smashed down 30% in a single day, physical silver in Shanghai was trading at a $40 premium. The paper market and the physical market have officially divorced. They are currently living in separate houses, and the paper market is the one that's about to get served the divorce papers. Now, mainstream analysts love to compare today to 2011. They say, look, silver hit $50 and then it crashed down, so it's going to do it again. But they're looking at the wrong playbook. The current setup is not 2011, it's more like the 1920s bank run. Now, in the 1920s, banks lent out more gold certificates than they actually had gold in the vault. And as long as everyone was happy with the paper, the system worked, it was fine. But the moment people started asking for that shiny yellow stuff, the banks shut the doors because they didn't have enough in the vaults for them. In the 1980s, the Hunt brothers tried to corner the market, and the exchange stopped them by banning buy orders. In 2011, they stopped the rally by hiking margins into the stratosphere, something we mentioned earlier on that they have in their shed waiting to go. But in 2026, there is a new variable: industrial demand. You see, in the 1980s, silver was a luxury and a hedge. Today, it's a strategic industrial material. You cannot build a solar farm, a 5G tower, or a semiconductor without silver. Now, I don't just analyze the supply chains, I invest in them. So to see my current semiconductor stock portfolio and my technology strategy, sign up to eToro via the link below in the description and check out my verified public portfolio. Now, unlike any investor who can be scared out of a position by a price drop, a manufacturer like Tesla, TSMC, Intel, Samsung, they must have this metal to keep their factories running. Industrial demand is forecasted to consume 125 million ounces for solar panels alone in 2026. They don't care if the price is $30 or $300. They just care about the physical molecule. And 4 of the biggest US technology companies have come together to forecast the capital expenditures that will reach around $650 million in 2026, which is up from $400 billion in 2025. That's a 62% increase in 1 year alone, and it's said to be the start of a super cycle of AI and semiconductor manufacturing. So this is essentially a black swan event for the COMEX. You can scare a spectator, but you cannot scare a supply chain manager who has $1 billion production line sitting idle behind him. Now let's talk about the date every institutional trader has circled in red. February the 27th. This is the first notice day for the March delivery contract. This is the moment of truth where paper meets metal. And historically, only about 1% to 2% of COMEX traders actually ask for delivery because usually they're happy just to flip the paper for a profit. But in the last year, that percentage has been climbing. If just 15% of the current open interest asked for physical delivery in March, it will require around 75 to 80 million ounces. Now, recall what I told you at the start of this video. The registered vault only has 103 million ounces in total. If the delivery request exceeds available supply, the price discovery mechanism breaks. We move into a world of price by negotiation. This is why the lease rates are currently at 8%. The banks are terrified of February 27th. They're scrambling to find every scrap of silver in London, Zurich, and Singapore to bring back to prevent a default of delivery. Now, the COMEX is currently performing a high wire act with no net. They're trying to suppress the price of a metal that is in a 5-year structural deficit during a period of unprecedented industrial demand, while their vaults are at 20-year lows. This is not a conspiracy. It's a supply chain failure. The magic trick of the last 40 years, where we were sold 100 ounces of paper for every 1 ounce of metal, has finally been exposed because the industrial world needs physical silver. So what are your thoughts? How do you think this story will end in March? Comment below. I'm going to read all of them. Take it easy. Peace.